still in the studio. He is a university lecturer and a business consultant. We're talking about the bond market. Says something has happened in the last week in the market. The government went to the market with an infrastructure treasury bond.
Yes.
And they are quoting it at 16%.
Yes.
And that is going to have a ripple effect on very many other sectors and very many other things.
Yes.
The first thing that you said is the effect it will have on the previous bonds that had a lower rate
of return.
And people were holding that bond, all scrambling to try and get into this new one.
Yes.
And therefore trying to sell off what they have, which means that they flood the market with that cheaper bond, which gets even cheaper.
Yes.
Okay, that is number one. Number two effect?
Number two effect, if you look to something like the real estate sector, the rate of return there is about 5%. You take an example, someone who has an apartment in Kilimani, Kileleshwa, Lavington, Westlands. That apartment is worth about 10 million. And this person is getting a rental income per month of about 50,000. That is 50,000 multiplied by 12 in a year. It's about 600,000. If you less what we call service charge, maintenance fee, and maybe sometime the apartment might be vacant, that 600,000 can reduce to 500,000.
Yes.
So 500,000 divided by 10 million multiplied by 100 in terms of now we are looking for the rate of return per year, it is 5%. So
it actually reduces by more because that particular area is now saturated with many high-rise flats.
That's for sure.
So the would-be rent pursuer has more options than they know what to do with.
That's for sure. That's for sure.
And so, and then with a dwindling economy, the likelihood of people who even live there staying there is also dwindling.
For sure.
So if you own a block of flats, the likelihood of occupancy even being at 50 is a tall order.
Is a tall order.
Yes. So that percentage you say is a kind percentage.
Is a kind and a generous one. So, if you compare that rate of return for the real estate investments, which have been actually the darling of many investors in Kenya. So real estate is giving you a return of 5%, the government is giving you 16%.
Surely.
Would you go to the real estate?
Government.
Straight up.
I wouldn't even have to think twice.
So we are likely to see a stagnation in the real estate sector, and it has been one of the economic drivers of this country because it falls under the sector of manufacturing. So there's a challenge. Now we come to the issue of shares. Because as we have seen, the NSE on the wing of shares, it has been struggling. Many companies actually, when they declared their financial and their annual financial reporting a few months ago, actually in April, most of them they either reported reduced profitability compared to other years or even suffered losses. So the value of shares have continued to go down. And right now, the market capitation of the NSE shareholding is about 1.5 trillion. In 2021, January, it was 2.7 trillion. So the market capitation of NSE has shed value of more than 1 trillion. So what now that means is that when government is giving a better rate of return through treasury bond, you would want also to sell your shares and buy the government bond, which is again is tax-free. So we will see many people struggling to offload and to offload their investment in shares. And right now, the NSE is struggling because we have experienced foreign investors' flight because they have realized that the currency in Kenya is quite unstable, and they prefer to invest in developed countries like now the US, and especially now the US that has continued to increase the interest rates that they are giving on their treasury bonds. So NSE is likely also to suffer in a big way. So
there's capital flight from Kenya because people are now going to that other, which is bigger, better, more beautiful girl called the US that is lending at a higher rate.
Yes.
So we are not even attracting more money here.
We are not attracting.
And
it's strange because I would have assumed that if the exchange rate between, say, the Kenyan shilling and the dollar or the euro
yes,
dipped in favor of these harder currencies,
yes, yes,
that an investor would find it cheaper to invest here simply because the exchange rate would favor them. But the opposite seems to be happening.
It is the opposite. You know what is happening is the Kenyan currency losing value vis-a-vis the dollar. And if the foreign investor had come here in Kenya and was promised a rate of return of 10%, for instance, you come and invest in yes.
I've got it.
You have got it.
I've got it.
Yes.
I've got it. So essentially,
yes,
you'll be losing money.
You will be losing money.
Yes.
You have been promised 10%, but the currency has lost value by 20%. So in the real sense, you are on the negative. You have gained 10, you have lost 20.
Okay. I want to understand,
yes,
if we're essentially saying a situation has been created where in the domestic market,
yes,
there's surplus funds. Yes, there's money to be borrowed.
Yes, yes,
by government.
Yes, yes.
Why wouldn't they do that?
The problem with that is when the government is actually increasing the interest rates so that to convince the locals to do business with the government. For the longest, actually something like the treasury bills, they have the rate of return for treasury bills, the one that we said it's a financial instrument whose maturity term is less than a year. The rate of return for treasury bills has been 7%, 8%. Because again, we are still comparing with the banks. The fixed, if you save with the bank, if you open a fixed bank account, they will give you a maximum of 4%. So the treasury bills have been for the longest 7 to 8%, but now in the recent past, in the last few months, all of them, even if you are investing with the government for 3 months, for 6 months, for 9 months, all of them, the interest rate is above 10%. We say double-digit figures, and there's something. There's a liquidity preference of money. That when you are lending short term, you should demand a lower rate of interest. But when you are lending long term, you demand a higher rate of interest. But now, every other person, majority of the local investors, they are avoiding investing with the government long term. And whenever the government issues treasury bonds and treasury bills are usually oversubscribed. But people are avoiding treasury bonds because it means you will lock your investment for a long time with the government. So every person wants to invest, most majority, to invest with the government for 3 months. After 3 months, the government will give back your money. Yeah. So in case there are some other changes, shocks, you are out. So the government now, to convince Kenyans to invest with them long term, now they have decided to entice them more by increasing the rate of return.
What does that mean? Does it mean, because do I detect desperation here on the part of the government? Because not only are they competing with the banks, they are doing much, much better than the banks, and they're doing much, much better than everybody else in the financial market.
Yes.
Is this a good thing?
It is not a good thing, because the banks, actually the government is kicking the can down the road. That these interest rates that we are promising investors, in the next few years to come, the debt servicing cost for the government will skyrocket. But as we are concerned about the here and now, but a few years down the line, now that's when the crisis will catch up.
This is about sustainability.
Yes.
When you borrow at 16%, and you're borrowing for development, and how long is this infrastructure bond?
It is 7 years.
It's a 7-year bond.
Yes.
What is it that they are going to do in 7 years that will earn this kind of money back?
Actually,
you know that you can say that you invested in dams, all right? Now, the ripple effect of having this dam here is the agricultural activity downstream that has developed the economy. 16%, you have to at least it makes 16% in 7 years. How plausible is this?
It is almost impossible, because right now we are feeling pressure, because the last government actually borrowed the $2 billion in 2014 through Eurobond
for SGR
for 10 years, and ideally they should have pushed for that years. So that since this is a developmental investment, capital expenditure, we should have bargained for more time. So that by the time when we bargain for more time, it means we are paying a lesser amount of money per year, but we pay for a longer period of time. So that one would have been more sustainable. So what the government probably would now needs to do is actually also to move away from commercial loans and increase the appetite for concessional loans. And these concessional loans are the ones that are issued by multilateral organizations, like now the IMF and the World Bank. And we try to avoid commercial loans like now the Euro bond.
Dr. at that point in time, in 2014,
yes,
exchange rate was 85, 86.
87 there.
You're talking about some 50 plus. It's a colossal sum.
It is. And now what we are planning to do is to roll over. Instead of paying that $2 billion US dollars, we issue another Eurobond, so that since we have not been saving that money,
so it looks as
we
though
kick the can down the road.
Right. So it looks as though we'll forever be in this situation. It's just going to continue rotating. Whatever is left, carry it forward, borrow some more, carry it forward, have a good conversation, so that somebody says, "All right, we'll look at that." A new administration comes into place. You keep rolling. What is the danger of that when you're looking at it from a nation's economic outlook? What's the danger of that? Because we seem to have the blinkers on. Well, we seem rather not to have the blinkers on, saying there's caution here. The blinkers are not on.
That's for sure. The danger in that, the worst that would happen is us going the Sri Lanka way, where we default on the sovereign debt, and because of that, the inflation increases. Like now, the inflation in Ghana is at 42%.
Yes.
And here in Kenya, the inflation is at 8%, and we are feeling the heat. So we can imagine how it is like there in Ghana. And something else that the government is doing, which is not having the intended results, is the government has been increasing the lending rate, the BESO lending rate, the CBR rate. It is now at 9.5%. Last year, at a time like this, it was 7.5%. Wow. And the government increased in an effort to tame inflation. So right now, the CBR rate at Ghana is 29%. CBR, the BESO lending rate in Ghana, it is at 29%. And nevertheless, it has not been able to tame the skyrocketing inflation there, because inflation there is at 42%. So the government sometimes gets it wrong when they say every other time there is inflation, the first remedy or cure is to raise the CBR, the BESO lending rate. Because right now, and whenever the BESO lending rate is increased, what that means is that you and me, it becomes difficult to borrow money from the bank, because
banks
the borrowing cost,
CBR plus 4.
Plus 4.
So in Ghana, you're borrowing at 34%.
At 4%. Actually, Eric, now we have moved away from that capping.
From that capping.
Now the banks are doing risk-based lending.
In other words, whatever they like.
It's free fall.
Yes.
It's a free fall. If they think you are not good enough, they give you at 19%.
If they think you are dicey, 30.
Yes.
If you don't want, leave it.
Yes.
Hey, God Almighty.
Who makes the decision?
Yes.
On this rate, for example, when the government went to the market last week,
yes,
who in government made the decision to float it at 16%?
It's a good question. Actually, how two things. Number one is that that rate is informed by the prevailing bond yield of the existing bonds. The prevailing bond yield. Right now, the bond yield for the treasury bonds that have been previously issued by the government is at around 16.75%. 16.75%. And the bond yield is what we said that if you were to buy a bond in the secondary market, because when you buy from the government, that is the primary market. But if you are to buy from the secondary market, that bond that was someone had purchased at 100,000, right now he cannot be able to sell at 100,000. Probably he will sell at 70,000. But the person who has purchased this bond, the new owner, will continue to get the rate of interest return as the initial owner, which was so basically, if you have borrowed at 70, if you have invested 70,000, but you are still continue to get a rate of return 10% of the 100,000, so that is 10,000 over 70,000. So the rate of return now, that is what is called yield. So there's a difference between yield and coupon rate. Coupon rate is the original interest rate that the government issues at the primary auction. But when someone is buying in the secondary market, now that changes.
So the base indicator when the government is going to the market is the yield.
Is the yield
of the previous, the current bonds.
Of the yes.
All right. And that is what is currently at 16.5.
Yes.
So that informed them to come at 16%.
Yes.
Do they need to go to Parliament to seek approval to borrow, to raise this infrastructure bond, or did this approval come with the passage of the budget and the appropriations?
Last year the government had purposed to borrow domestically 887 billion. By end of April, they had only managed to borrow 497 billion.
You make it sound like it's a competition. Only managed to.
Yes,
they tried their best.
Yes. They have been. We have been experiencing investors' apathy, whereby the government issues treasury bonds, but the rate of subscription is about 25%. If the government had intended to receive about 50 billion. It ends up receiving about 15 billion. So because of that, the government has been behind schedule. And that's why when it got that opportunity last week, because actually this bond, they had intended to collect 60 billion. But to their surprise, people oversubscribed. And people are willing to give the government to a tune of 220 billion because the incentive was very enticing. But at the end of the day, the government was able to take 213 billion. So there are two things that are coming into play. One is the issue of the interest rate is very high. And number two, the government changed the story midway. Because initially it intended to borrow 60 billion, but because now people are willing to lend to the government more, they took more.
Dr. Kamau, always a pleasure having you. Thank you very much for joining us today.
Thank you very much.
Looking forward to the next one.
Wonderful.
And thank you very much for tuning into the Situation Room today and all the comments that we see on social media. Keep them flowing. Let the conversations continue. Have a lovely day. It's 10 a.m.